I've been investing in the stock market since others still collected Pokemon cards, through several market crashes and bull markets, and this is what I wish I knew before starting. I will go through how stocks work and then step by step how you can start investing in a thoughtful and smart way so you can start building your capital. Each share represents a small part of the ownership in a company. If you buy an Apple share, for example, you own a small part of Apple, and if the company does well, its value will increase and the value of your shares increases as well. You also sometimes get part of the profit that a company makes in the form of dividends. The stock exchange is the place where stocks are traded, and the large US stocks are traded either on New York Stock Exchange or the Nasdaq. So before, these were physical places where stockbrokers went to buy and sell shares, and you've probably seen these images before. But now the trading takes place digitally. And the most important thing is that there are two main ways to make money on stocks. And the first of them is that you buy a stock for a certain price and then sell it for a higher price. Then you have made money on the price increase. And the other common way to make money on stocks is through dividends. So some companies choose to reinvest their entire profits in order to grow more, and some instead distribute a certain part of their profits to the shareholders. Well, there are actually three ways to make money on stocks, because you can also short sell stocks. So this is when you make money on a stock decreasing in price, but this I wouldn't recommend to beginners. So a stock that pays out dividends is called a dividend stock, and they're also increasing and decreasing in value, but usually not as quickly as stocks that don't pay out dividends. So the total returns of a dividend stock will thus be the sum of how the price moves and also the dividend. And many people like dividend stocks because they see it as a form of passive income that dips into their account regularly without you having to sell off anything. And you get a dividend regardless of whether the stock price goes up or down at the moment. But it's not necessarily so that a stock that paid out a certain amount last time will do it again. Likewise, as it's not necessarily so that a stock that has gone up in price recently will continue to do so. Nonetheless, this became apparent when many dividend payouts were cancelled in 2020. So what can you expect in returns from investing in stocks? You may have heard that the stock market on average gives around 8 to 10% in returns. So this is when you look at them, all the stocks together and long term. An individual year rarely ends up at just 8 or 10%. But there are large fluctuations up or down, and this is what we call volatility, and therefore it's recommended not to put your money into the stock market that you want to use within 10 to 15 years. And here I've calculated the annual returns of the stock market since 1926, and as you can see, the worst year ended up at more than 40% loss, where the best year went more than 50% plus. And the outcomes of all the other years then ended up somewhere in between these two extremes. You can also see that the best 3-year period went up by an average of 30% per year, while the worst 3-year period went down by more than 25% per year. And we also see that no 15-year period since 1926 has produced a negative outcome. The worst 15-year period went up on average just over 0.5% per year. It doesn't sound very good, but it shows that if you invest long term, you can have a certain expectation of not going minus, even if you're seeing red numbers short term. And the longer the time period we look, the closer we get to the stock market long term average of around 10%. Such a long term perspective is therefore important when investing in stocks. Alright, so now you have a better grasp about how the stock market works. So let's go through step by step what you should do when starting investing. Step number 1. Actually, before you start investing, it's good to make sure that you have an emergency fund in your savings account for unforeseen events when you may need money quickly. It could be that the refrigerator breaks down or your car needs to be repaired, for example. But it could also be that you need extra money if you lose your job. In the events of unforeseen events, you want to avoid having to sell off your stocks. This might not always be the best time to sell, and only you can answer how much you should have in your emergency account. Some recommend that you can manage a full year of expenses, and some say maybe a couple of months. It probably depends on how confident you feel about your source of income right now and how well you think that you can be able to cope if you didn't have them. So once you have your emergency fund, it's time to take step number 2, everyone should do before starting investing, and it's to pay off any high interest rate debts. So by this I mean, for example, consumer loans that can have a very high interest rates. So I would recommend paying off everything that has an interest rate over 5%. So when you pay off a loan, then you get returns that are the same as the interest on the loan. And at the same time, this is a risk-free return. So after debts with high interest rates have been paid off and you have your emergency fund, we can focus on investing. So step number 3 is to figure out your means and goals. So think about what goals you have for your investments, how much you can invest initially and how much you want to save each month. If it's perhaps a more short-term savings goal of a couple of years for investment to the down payments of a house, for example, then money shouldn't be invested at the same high risk. Or if you have a more long-term goal where you're investing for your retirement, perhaps for several decades, then stocks and funds may be better for you. So how much would you like to get in the end? It also matters how much you think you can contribute with each month. If you come to the conclusion I want to save long-term for 10 years or more, then a portfolio with the majority in stocks and equity funds is for you. So step number 4 is to arrive at what level of risk you should take. When you buy and sell shares, you postpone consumption today to have the opportunity for more consumption in the future. I mean, if you invest 1,000 today, you choose to invest instead of buy something, a new iPhone for example, and by giving up this today, you hope that you will have more money in the future so you can afford to buy maybe 2 iPhones. And for this sacrifice of immediate satisfaction, you expect compensation in the form of returns. And there is a risk in trading stocks. You don't need to invest 100% of your money, of course, in stocks, but in principle, the more risk you take, the higher the returns you expect. There are 2 major risks with stocks, and one risk lies with the stock market itself. The entire stock market is moving up and down, and there's a risk that something will happen, as we saw in 2020 for example, which means that most stocks will die, regardless of whether they are good or bad companies. Then there's a risk with the individual stocks or the individual companies as well. There's always a risk that an individual company may perform badly, even though the stock market as a whole is going up, so that the stock price is going down, no matter how the market as a whole does. This risk with individual stocks can be reduced by owning several stocks, so you don't receive any extra compensation for this risk. If you own stocks from around 12 different companies, you have in principle reduced this risk almost as far as possible without you having to own thousands of them. So please don't go investing all your money into one single company. So how much risk should you take? This is not an easy question, and this is nothing that anyone but yourself can answer. Do you feel comfortable with seeing your invested money go down by 50% or more? And it's easy to sit here now and be, of course, 50%, easy peasy, no problem, I can take that. But once you sit there in the middle of a crash and don't know where or when it will end, it's a completely different thing, believe me. If you knew that the end, for example, would be at 50% loss, it might have been a different situation, but what if this particular crash is not like previous ones? What if this time the stock market doesn't recover and you have lost everything? What I'm trying to say here is that it's easy to sit with the results in hand and be smart in hindsight, but when you're in the middle of a crash and don't know where it will end, it feels much worse. So really think about how much risk you're really willing to take. And the younger you are, and if you're saving long term, for example for retirement, the higher the risk it makes sense to take. So when you approach your savings goals, you can start reducing the risk. So step number 5 is to arrive at the investment strategy you want to use. So the last thing we want for you is to sit and fish stock tips in various Facebook groups or on Reddit and then lose all your savings. Or try to invest based on gut feelings. Here it's important to have your own strategy and to follow it. Or why not have more than one strategy? There's nothing that says that you only have to settle for one. It's even an advantage if you have several, because there's no strategy that will always outperform the others. So there are many different investment strategies, but you can basically collect them into 3 categories. So the more active strategies, where you invest in individual stocks through either fundamental analysis, where you look at companies' key figures and fundamental data, or through technical analysis, where you analyze historic stock data, or a more passive strategy where you invest in funds. And then you can choose either actively managed funds, where a fund manager instead chooses which shares they think will do best, or passively managed index funds, which follow the stock market in general. So it's worth noting that there's nothing that says that you will surely make more money just because you're more active and choose stocks yourself. Rather, the research says that it's actually the opposite, and that there's no way we can actually predict or know in advance which stocks will do well in the future. So check out this video for more info. You really don't have to buy and sell all the time to earn money either on stocks. Then it's very easy that your earnings are actually eaten up by brokerage fees and other fees. So start by deciding how active you want to be. Do you have the time and interest to spend on analyzing individual stocks or stock charts? If you have less time or interest, funds might be more for you than individual stocks. So it's good to write down the strategy as well, I think, on why you choose it, and then you can go back later if you feel uncertain. And know both when to buy and when to sell. Don't begin with stocks with the mindset that you think you will get rich fast. Yeah, it's possible if you take huge risks and are incredibly lucky, but the probability of this is minimal and, on the contrary, extremely high that you're actually going to lose everything instead. So don't think of the stock market as a casino, and don't chase rapid gains, but instead invest long term. And monthly savings, where you invest a certain amount each month, is a really good strategy. Check out this video for a deeper look at why. But in short, it removes a bit of the so-called human factor that you have to decide or guess when it's the best time to buy. With monthly savings, you will buy sometimes when prices are higher and sometimes when they're lower. And don't try to time the market either, because no one can predict the future. This is one of the things where us small investors lose the most money on. I've linked an interesting market simulation below so you can try out yourself how good you are at actually timing the market. Link down below. So step number 6. So now you're really properly prepared and ready to start investing. But where do you start? Which broker is best? It depends a bit on what you want to invest in. For example, if you want to buy stocks, different brokers take out different commissions. This is the fees that you pay to buy or sell shares. But don't be fooled by the brokers offering commission-free trading. They're for sure not giving you free money here, but instead they make money on the spread. The spread, it's the difference between the ask and the bid price of a stock, or simply the price that someone is willing to sell for versus the price that someone is willing to buy for. So if you instead want to invest in funds, some brokers may have a larger selection of these or offer discounts for actively managed funds. And a third broker may have a better website or app that makes it easier to buy and sell. Would you be interested in a video where I go through exactly how to buy or sell a stock and what to consider regarding this? Let me know in the comments below. And let me know also if you have any other questions as well. Either you can answer them directly or you can make a video about it. So now I hope you have a better understanding of the stock market and where to start. So don't forget to hit like and subscribe for more videos on stocks, personal finance, and how the stock market really works. Good luck investing and see you all next time.